Well, it looks like inflation is a little bit stickier than anticipated, with the latest CPI for March coming in at 3.5%. Considering inflation at 3.5% for the month of March means that prices are rising at a faster rate than both February and January, it's probably an indication that inflation and the fight against it is here to stay. From the perspective of consumers, such as you and I, this is a problem because it points to a situation where things continue to be unaffordable because of unaffordable prices and unaffordable financing. Let's look at the CPI data for March. Overall inflation was 3.5%, core inflation was 3.8%, and that's just overall inflation minus food and energy, which came in at 2.2 and 2.1% respectively. And quick note, the reason why core inflation removes food and energy is because those two categories are considered relatively volatile, meaning that the people that collect this data know that it's difficult to gauge the month-to-month movements of those prices. But those numbers are just a general overview of our current situation. To get a better understanding, a deeper understanding for how these things impact your personal life, let's look at the categorical data in which you can find things like food, energy, utilities, new vehicles, used vehicles, apparel, transportation services, and much more. I'm sure to no one's surprise, pretty much across the board, everything is meaningfully up in price, with a few exceptions. Two of those being the new car market and the used car market. There's also some outliers here that come in even above core inflation, like food away from home at 4.2%, electricity at 5%, and transportation services at 10%. If you find yourself looking at your budget and wondering why is it that you spent X amount of dollars more this month than the previous month in a particular category, if you look at this data, it probably explains why. I do want to bring up the fact that the Fed is using the term supercore inflation quite a bit when describing the current situation. Supercore inflation is overall inflation minus energy, minus food, and minus housing. And their whole justification for getting rid of housing in that number is that housing has also become volatile. But here's the thing. Although core inflation and supercore inflation might be better long-term indicators of where the economy is going relative to inflation, for you and I, it doesn't mean a whole lot on a month-to-month basis. If food, energy, and housing are all up in price, that is something that are necessities that are affecting us every single day, and there's nothing we can do to escape it. So if inflation is indeed a lot more stickier than the Fed first anticipated, the likelihood of them being able to cut rates has decreased significantly. Remember, the Fed uses interest rates to influence economic factors that contribute to inflation. That's why they had to hike rates as quickly and as high as they did when we were experiencing hyperinflation. If y'all remember, inflation rates were as high as 8-9%. And without getting too deep into the economics of it, the reason why the Fed uses interest rates to fight inflation is because there's a direct relationship between the inflation rate and where interest rates are. If inflation is high above the Fed's target that they're comfortable with, they will use interest rates to bring those levels down by slowing activity in the economy. And for those of you that might be a little more interested in the application of economic theory, go check out the Taylor Rule, which was a rule created by an American economist named John B. Taylor, in which he established a relationship between the federal funds rate, inflation, and U.S. GDP. The Fed might not be able to cut rates because if they were to cut rates, it would stimulate the economy so much so that inflation would go even higher. The only reason they were ever considering cuts is because relative to the peaks of inflation, yes, sitting at 3% is improvement, but they thought they were going to see a lot more. And then couple that with the fact that the job market has been extremely strong, which is one of the main indicators that the Fed uses for their decisions. Last month, it was reported that over 300,000 jobs were added, dropping unemployment to 3.8%. And not only were jobs added, but wages grew, so much so that the wage growth outpaced inflation. Throw on top that US GDP is still going strong, and you can see why the Fed thought a soft landing was possible. That's kind of what makes the Fed's job so damn difficult, is they're stuck between a rock and a hard place in which they have a dual mandate. Not only is it price stability in their fight against inflation, but their second mandate is maximum employment. Those two mandates don't always go hand in hand, because to achieve one, you might have to hurt the other, and it looks like that's where we're headed. From the perspective of the Fed, when they're looking at the national level data, when they're looking at the net effect of their monetary policy, to them the economy is really strong. In fact, it might be too strong. The Fed will not make moves unless they see a little blood. And by blood, I mean unemployment. And I hate saying that, because on an individual basis, unemployment is terrible. There's nothing good about it. But for the Fed, if they see unemployment rise, they know that that's a pool of potential buyers for goods and services that are no longer there, because they don't have a steady income coming into the households. So if you remove those buyers from the market, those prices that are being driven up every month, well, that effect isn't necessarily there anymore. And now this is the domino effect of monetary policy. Because interest rates are a blunt tool in a fight against inflation, it's very difficult to determine what the net effect of increasing rates will be, or even keeping them where they are right now, which I believe is 5.25 to 5.5 last I checked. If rates remain elevated, there is a greater likelihood that we do enter a recession, that the Fed gets too aggressive with their fight against inflation, and they put us in a position where companies contract, financial markets contract, and the economy contracts with it. And hey, I know all of this seems a little abstract, because it is. Monetary policy is macroeconomics. They're looking at high-level data. They're making high-level decisions on the net effects on a population. A lot of times, it overlooks an individual's experience in certain markets. But I think a great example of how interest rates can affect the prices of goods and services is what's happening in the housing market and the car market. If you look at the quarterly housing affordability index created by the National Association of Realtors, you can see that they collect data to formulate an index on the basis of home prices, mortgage rates, what those payments would be, and that payment as a percentage of income. And I'm sure what you can see right off the bat is, relative to 2021, housing affordability at the end of 2023 and going into 2024 was terrible. As the Fed was raising their federal funds rate, those rates were bleeding into the markets for mortgages, hence why we're seeing mortgage rates of 7, 6, 5%. And with those higher mortgage rates, because housing prices have been somewhat resilient to that monetary policy, the affordability has gone down, because you're expected to pay a lot more on that mortgage relative to a few years ago. So the housing market is an example of how interest rates haven't necessarily had that great of an effect on the overall market in terms of prices. Assuming they can't cut interest rates and they have to keep them at a certain level, well, for housing to become more affordable, there is no other option than for housing prices to come down. But if they come down too quickly or too much, well, that's when the housing market enters a correction, and that's an indicator for a recession. On the other hand, if you look at the car market, this is a good example of how interest rates do seem to be having an effect on car prices. If you look at the car affordability index relative to its peak in 2023, we have made significant improvement. Whereas a car would have cost you almost 41 weeks worth of income to purchase that vehicle, it now costs you about 37, which is still high, but it's trending towards a level that is more in line with the affordability of 10 years ago. So the Fed raised their rates, and those rates bled into the rates for mortgages and the rates for auto loans. But in the housing market, we see a great example of how that monetary policy has a lagging effect on housing prices. But on the other hand, in the car market, we see how there's actual improvement in terms of affordability. The point being is that the Fed is having to do this balancing act. Imagine a seesaw with the consumer, like you and I, in the middle, in which on one end is high prices and on the other is high interest rates. And they're having to balance these two factors such that we can afford to buy things and we can afford to exist in this economy. I don't envy their job, that's for damn sure. As much as I would like to say that I think that the Fed is going to keep rates where they are, inflation is going to respond within a couple months' time, and then they'll cut rates, stimulating the economy, stimulating the stock market, making things more affordable. I don't know for sure. And anyone that says that they do is either flat out lying to you or they're delusional. No one knows for sure, but they're gonna have to do something, because what you can't have is elevated prices coupled with elevated interest rates that creates a situation where nothing is affordable. With all of that said, I don't mind taking a guess and seeing if I'm right in a couple months, but I think the Fed's going to prioritize their fight against inflation. That is just one number that most consumers cannot accept. Interest rates, sure, they affect the financial markets, they affect financing, they affect certain markets, but inflation affects all markets. In a recent survey, 65% of surveyed Americans indicated that they were living paycheck to paycheck. Of those, 69% cited inflation as the main reason why. 59% cited lack of savings, and only 28% cited rising interest rates. So that's why I think the Fed is going to maintain a relatively aggressive stance on monetary policy, and I'd be curious to see if inflation stays sticky for April, May, June, and so on. Do they even entertain rate hikes? Ladies and gentlemen, if the Fed even alludes to reintroducing rate hikes, you better hold on to your butts because things are going to get crazy. Until then, I will keep my eyes open on any further news that I think needs to be shared on these topics. But I'd like to hear from you. What do you think about how the Fed's doing? Are they doing a good or are they doing a bad job? What are you feeling more, inflation or high interest rates? As always, thanks for watching. Until next time, take care of yourself and best of luck.